Hi, in this section, we will see the valuation of goodwill under the second method, which is the super profits method, and we'll also solve example sums under this method. In this particular video, we will see the formulae for calculation of goodwill under the super profits method and also understand a few concepts and terms which is related to this method, as well as the basis or assumption behind valuing goodwill under this method. So let's go on to the super profits method. Now under the super profits method, value of goodwill is equal to super profits into the number of years purchase. Now here super profits is equal to the average profits of the business minus normal profits. And normal profits in turn is equal to average capital employed into NRR, or the normal rate of return, divided by 100. Now we will see in detail about the meaning of average capital employed, how to calculate this, the meaning of normal rate of return, what is super profits, and the assumption or basis behind this method with the help of an explanation. Let's begin with what is the meaning of average capital employed. Average capital employed. Capital employed refers to the capital which is invested in the firm to carry on the business. So the capital invested in the firm is referred to as capital employed. Average capital employed is equal to the capital employed at the beginning of the year plus the capital employed at the close of the year divided by 2. So the capital invested in the firm at the beginning of the year plus the capital invested in the firm at the end of the year. After adding these two up, if we divide it by 2, we get what is called the average capital employed. But in most sums, it may not be possible to find out the opening capital employed and closing capital employed separately. So assume that whatever is given or ascertainable is average capital employed. Now, how do we calculate the capital employed or the capital which is invested in the business? There are two approaches to calculate this capital which is invested in the business. The first one is called liability side approach, and the second one is called asset side approach. Now, to calculate the capital employed by means of the liability side approach, we need to add the capital of the partners plus any reserves minus existing goodwill, that is goodwill already appearing as an asset in the balance sheet, minus fictitious assets, and also deduct the non-trade investments. To calculate the capital employed or capital invested in the business through the asset side approach, we need to take all assets from the asset side of the balance sheet, but we need to exclude the existing goodwill, the fictitious assets, and the non-trade investments. And after we take this figure, we need to deduct the outside liabilities. We need to remember that investments are considered as non-trade investments unless specified otherwise. So if just investments is given in the asset side of the balance sheet, we will consider it as non-trade investments. Also, the examples of fictitious assets are advertisement suspense, deferred revenue expenditure, etc. So we saw the meaning of capital employed. It was the capital which is invested in the firm, and how to calculate the capital employed by means of the liability side approach and the asset side approach. Now we will see an example to calculate the capital employed. Example for calculation of capital employed. We have a balance sheet of the firm which is given as at 31st March 2019. Now from this balance sheet, we will calculate the capital employed beginning with the liability side approach, and then we will go on to calculate the capital employed using the asset side approach. Now if we recollect the formulae for capital employed under liability side approach, it was the capitals of the partners plus reserves minus any existing goodwill minus any non-trade investments and also minus fictitious assets. So based on that, the capital of the partners is rupees 3,50,000 plus rupees 70,000 reserve minus existing goodwill 60,000, non-trade investments rupees 22,000 has to be deducted, and fictitious assets, which is in the form of advertisement suspense, minus 8,000 also needs to be deducted. So it's 3,50,000 plus 70,000 minus 60,000 minus 8,000 and minus 22,000, which is equal to rupees 3,30,000. So this is a way we will calculate capital employed from the liability side approach. Now in the asset side approach, we saw that the formulae for capital employed is equal to all assets in the balance sheet excluding goodwill, non-trade investments and fictitious assets, which is in the form of advertisement suspense in this problem, minus the outside liabilities. So let's do that. All assets is 4,72,000 minus 60,000 is existing goodwill minus fictitious assets is 8,000 minus non-trade investment 22,000. This figure minus the outside liabilities. The two outside liabilities are creditors and outstanding salaries. So minus 40,000 plus 12,000 or 52,000, and we get the answer as rupees 3,30,000. So irrespective of whether we calculate the capital employed through the liability side approach or the asset side approach, we will get the same answer. Next, let us understand the meaning of NRR or normal rate of return. Meaning of normal rate of return. It refers to the normal profits earned by all firms in the same industry, which is expressed as a percentage of the capital employed. We'll see this by means of an example. Let's say the normal rate of return for all firms in the textile industry is 8%. Therefore, the normal profits earned by, let's say, firm A having a capital employed of rupees 1 lakh is rupees 8,000, which is 8% of the capital employed 1 lakh. On the other hand, the normal profits earned by firm B in the same textile industry having a capital employed of, let's say, rupees 3 lakh is 8% of rupees 3 lakh, which is rupees 24,000. So when we say that the normal rate of return is, let's say, 8%, for every 100 rupees capital which is invested in the business, the normal rate of return for all firms in this same industry is rupees 8. So that's the relevance of normal rate of return. Next, what is super profits? Super profits refers to the excess of actual average profit over the normal profits. So the formula is super profits is equal to average profit minus the normal profit. Now the procedure to calculate the average profit is the same as in average profits method. We can demonstrate this by means of an example. Now let's say the normal rate of return for all firms in the same textile industry is 8%. Also, the actual average profit earned by firm Z, having a capital employed of, let's say, rupees 5 lakh, is rupees 75,000. Now based on this normal rate of return 8%, all other firms in the same industry would earn, or the normal profits would be 8% of rupees 5 lakh, in other words rupees 40,000. But however, firm Z, which is in the same industry, is actually earning profits of rupees 75,000. So the excess of the actual average profit over the normal profit, which is otherwise called the super profit, is equal to rupees 35,000, which is the actual average profit of rupees 75,000 minus the normal profit based on the capital employed by Z, which is rupees 40,000. So this is the meaning of super profits. Now goodwill under the super profits method is equal to super profits into the number of years purchase. So what is the assumption behind valuing goodwill under this method? What is the basis or assumption of super profits method? This method is based on the assumption that when a buyer purchases a firm which is operating in a given industry, such buyer will have to compensate the seller in the form of goodwill only for the excess profit earned by such firm over and above the normal profits earned by all other remaining firms in the same industry. So I will explain this by means of an example. We'll see the explanation. Explanation for the super profit method. Now let's say that the normal rate of return for all firms in the textile industry is 8%. Now Z is interested in purchasing a firm, Shiv and Sons, in this industry, earning an average profit of rupees 75,000. Shiv and Sons has a capital employed of rupees 6 lakh and assume that the number of years purchase is equal to 3 years. That is, the number of years purchase is the number of years the new owner will continue to get excess profits based on the efforts put in by the previous owner. Now Z will have to compensate the seller for the excess profits or super profits that Shiv and Sons is able to earn over and above profits earned by all the other firms. So the profit or the normal profit earned by all other firms is 8% of capital employed rupees 6 lakh, which is 48,000. However, the actual profit which Shiv and Sons is earning is equal to rupees 75,000. Therefore, the excess of average profit over the normal profit is equal to super profit is equal to rupees 27,000. So Z expects to earn 27,000 rupees extra for the next 3 years after the change in ownership. Therefore, the compensation of goodwill to be paid by Z to the seller is equal to the super profit rupees 27,000 into the 3 years of purchase, which is equal to 81,000. So here in this video, we saw how to value goodwill under the super profits method. In the upcoming few videos, we will do example sums for calculation of goodwill under this method.